This week, I got a great question from a subscriber named Dave. Dave asks, have you done one or can you make a video of how to identify a stock or business that is a value trap? I see value traps mentioned in many value investing resources, but I haven't seen any videos on how to identify when a stock is a value trap. In this video, we're going to talk about, first of all, what is a value trap? And then to illustrate a couple of examples of actual value traps, I'm going to pull up an article from 2017 that shows the 10 lowest price to earnings ratio stocks in the S&P 500. Of those 10, there were 3 value traps. And we're going to look at the financial statements of those 3 stocks to see which ones were value traps and a couple things they had in common.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
First of all, what is a value trap? Most in the investment industry would define a value stock as a stock with a very low price to earnings, price to sales, or price to book ratio. Now, I personally disagree with this assessment of value versus growth. Growth is a part of value, and so a stock that's growing faster is naturally worth more than one that's growing less quickly. So this is an incomplete way to look at value, but let's just stick with a common example, which is using price to earnings ratio. So let's say we've got a stock right now that's trading at a price to earnings ratio of 10 times. In other words, for every $1 of earnings, this stock is trading for $10 in price. So if we flip this upside down, we can calculate that a $1 earnings divided by a $10 price equals a 10% earnings yield. So if this business is just able to maintain its earnings throughout time and pay out part of them as dividends and the other part to retain in earnings and generate at least $1 in market value for those retained earnings, we could expect to make 10% per year in this stock. And again, that assumes basically 0% growth. If the average stock is trading for around 20 times, which is the S&P 500's forward PE ratio today, so October 2021, it looks like this stock is trading at about half of what the overall stock market is trading for. So this stock looks cheap. But just because it looks cheap doesn't necessarily make it cheap. So if this earnings per share goes from $1 this year down to negative $1 next year and then negative $10 the year after that, there is no way that this stock should even be trading at 10 times earnings. It should be trading at basically 0 or lower because this business is probably going bankrupt. So the key is not necessarily if the stock looks cheap based on today's earnings. The key is what are the future earnings of this business, and does 10 times those earnings reflect a good purchase price today? So even a stock with a PE ratio of 1 could be overvalued if the future earnings power of that business is dramatically lower than it is today. To illustrate, I looked up an article on Motley Fool. I just did a Google search for low PE stocks, and the first one I clicked on was this one from the Motley Fool on May 26th, 2017. So it goes through the 10 lowest PE stocks in the S&P 500 using the trailing price to earnings ratios as of May 25th, 2017. So here was the list of stocks and what their PE was at the time. So we've got eBay, General Motors, Transocean, Gilead Sciences, Goodyear Tire and Rubber, Bed Bath & Beyond, Navient, Signet Jewelers, Corning, and Michael Kors. Which of these were values, real values, and which of these were value traps? To find out, I took a look at the performance from May 26th, 2017 to today, which is October 26th, 2021. I just looked at the price return, did not reinvest dividends, so there is going to be some small difference here, but this is what each of those stocks has produced over that time period. As a benchmark, I looked at the SPY S&P 500 Index Fund. So again, the price return over this time period was 89%. There was only one stock that did better, at least price-wise, than the S&P, and that was eBay. eBay returned 126%. The S&P was at 89. Every other stocks underperformed the S&P 500. You could argue that 9 of these were value traps. I personally am going to consider it only a value trap if it has substantial underperformance. I think you might be able to argue that Gilead being up 5% over this period constitutes a value trap, but let's just go with these 3. Goodyear, Transocean, and Bed Bath & Beyond. Each of those on a price basis was down 40% or more in an environment where the market was up almost 100%. I'm going to use a free data provider that I personally subscribe to. This is not an affiliate link. I'm not being sponsored by them in any way, shape, or form. I just really like the service, and that is quickfs.net. You can go there and type in any ticker symbol, and it will show you this exact data. So let's take a look at these 3 value traps to see what common denominators stand out. Here is Goodyear Tire. This was the best performer on the list, down about 40% from that May article. And it's important to remember that this article was published in 2017, so we're only able to see data from this point forward. If we take a look at this, there are just a couple things that stand out. First of all, a big red flag is this negative revenue growth for 5 consecutive years. A company that is shrinking its sales is not going to be able to last long. You can only cut costs for so many years before this starts to become a major problem. On the other hand, you do see that gross margins and operating margins are both steadily increasing over time. So it's possible that this company is shedding poor performing businesses in order to get higher margins. Right now, we've got a bit of a mixed picture. However, one major red flag is to take a look at this earnings per share number and see how volatile it is. Earnings in 2011 were up 250 almost percent from 2010 to 2011. Then they dropped by almost 50 the next year. Then they went up 210%, up 285%, and then down almost 100% before going up 300%. Typically, very good businesses have consistent earnings over time. Anytime you see a very wide variation, suggests that this business is probably in a very cyclical industry, so it's much likelier that you're ending up getting a low price to earnings ratio just because you have a temporarily high earnings per share number. If we would just take the longer term average, say over these entire 5 years or 6 years, you're going to end up with a number much lower. So my guess is if you looked at the actual average earning power of this business, PE would not look as attractive as it did in 2017. Another red flag is this return on invested capital number. Those of you who have watched the channel for a long time know that I'm a big fan of return on invested capital, and I'm a big fan of it because it tells you a lot about a business. In this particular case, Goodyear has pretty weak returns on capital. There is basically 1 year here where they showed an exceptional number, but other than that, you can see that they're about average, the average business here in 2016, but most of these numbers are below 10 with some below 5. So the major red flags here are slowing revenue growth, very volatile earnings, generally weak return on invested capital, and then the positives would be an increasing margin. In a lot of these cases, you'll notice that there's no clear cut and dry answer. Sometimes one metric suggests positive, others suggest negative. So it's important to do your homework, look into the reasons why. So maybe you look into revenue growth for Goodyear and you see that, hey, they've actually been selling businesses that are not profitable. Maybe they're shedding some of their business lines that have had lower, weaker margins. All of those are legitimate reasons for revenue growth to decline. So you always need to do your homework. But in this particular case, there are several red flags that might have steered you away from Goodyear in 2017. Now let's take a look at Transocean, ticker symbol RIG. And again, we're going to look at the data before 2017. So we would not have had anything on this side of the chart. And once again, we see that the last 3 years revenue growth was substantially lower for RIG. Of course, This was due to the lower oil prices from 2015 and 2016. Another red flag is this sharp decline in margins. So you had gross profit margins decline under 80, which was substantially lower than they had been at any point. Once again, we see that earnings per share are all over the place. So you had a negative number in 2011 and 2012. Again, in 2014, you had a negative number. The only positive year here was 2013. So if you took an average of all of these earnings per share over this entire period, it would actually be negative. Another red flag was multiple dividend cuts. You had one here, you also had one here, and then again, cutting to no dividend in 2016. And another telltale sign was just very dismal return on invested capital numbers. The highest ever achieved was 5%. Even when energy prices were higher, Transocean did not make attractive returns on capital. They lost money in a lot of cases. So this was pretty obviously a bad business just looking at these numbers. Again, do your homework. Maybe there's something under the surface that's hidden by these bad numbers, but just taking a quick look here, it does not look good for Transocean. And the worst performing stock of the group was Bed Bath & Beyond. So in this situation, we never had revenue growth that turned negative, but you did have slowing revenue growth from 2013, 2014, 2015, and 2016. It's not a huge red flag, but it's definitely something to be aware of. This company is at least not growing as fast as they once did. And you can see later on, which you wouldn't have known this at the time, but the revenue growth continued to decay. Another red flag is the gross margin declined every single year from 2012 through 2016. It wasn't a huge decline, but definitely something to keep an eye on. Operating margin was a little bit more substantial of a drop off, 16, 15, 14, 13, and then under 12. So you're getting a roughly 1% annual erosion. And again, you can see how that continued. Very troubling sign. Another red flag here is this steadily decaying earnings per share growth. You can see how 2012 was very strong, but then you had a huge drop off in 2013 and again 2014. 2015 was a bit of a boost, but then you're back down to less than 1% earnings growth. And again, 2017, you can just see how this got worse and worse through time. The most encouraging picture here is this return on invested capital. It was actually above average, so most businesses earn closer to 10. So they were earning about double returns on capital. However, it's important to always compare returns on capital to the rest of the industry. So if you've got something like Bed Bath & Beyond, maybe you compare it to another retailer that would be a competitor of theirs. That will give you a better idea of which has a competitive advantage and which does not. Some industries are just naturally higher than others, so it's definitely something to keep an eye on. The red flag with this number, though, is that you have decaying returns on capital from 2013 every single year down to 20% in 2016. So anytime you see a decaying return on capital number consistently over time, that's definitely a bit of a red flag. It's okay if it jumps up and down from year to year, but you shouldn't see a trend over multiple years. So of these three stocks, I think the one that would have been most difficult to pass on would have been Goodyear. There definitely were some positive signs there, but the other two, Bed Bath & Beyond and Transocean, I think it was pretty clear just with a quick look at the financial statements that these businesses were struggling and in some cases in pretty deep trouble. So let's just recap 5 things to look at in a potential value trap. One is revenues either falling or just the growth slowing consistently. Operating profit margins starting to decline is another bad sign. If earnings are shrinking or very volatile, that's also something to pay attention to. Another issue is if you see a lot of dividend growth, but no or negative earnings growth. Dividends cannot continue to be paid without earnings supporting them. So if earnings are going south and dividends are going up, that means the company is only boosting its dividend by increasing its payout ratio, which is not sustainable. Either the earnings have to go up or the dividends have to come down. And then finally, returns on invested capital, either well below average, so well below, say 10%, being the rough long-term average of most companies. If it's below that or falling, it's possible that it could be a value trap. These are not hard and fast rules. There are a lot of reasons why a company might show a worrying sign that may be something completely legitimate. It also could just be a temporary decline in the business, when in reality it's going to jump back up in the future. So for example, 2021, 2020 looked pretty bad for a lot of businesses and a lot of sectors. Some of those turned out to be really good buys just because the business eventually came back. So it's difficult to know exactly if a stock is a value trap or a value, but hopefully these give you a couple of clues. If you have any other questions that you'd like me to answer, leave a comment in the comment section. If you want to know more about returns on invested capital and why I think it's one of the most important metrics you can look at, check out this next video right here.